Now in this video, we'll look at Modigliani-Miller's proposition 1 and 2 with taxes. So in Modigliani proposition 1 with taxes, it states that the value of a levered company is equals to the value of an unlevered company, which means there is no debt, plus the tax rate times the total debt. So this proposition tells us that it is beneficial for the firm to use more debt, because the more debt you use, the higher the tax shield or the benefit from using debt. Okay, because interest is tax deductible. So the more debt you use, the higher the value of the levered company. Now, proposition 2 with taxes states that the cost of equity of a company is equals to the cost of a company's equity if it uses 100% equity, which is R0, and then we'll add in an incremental spread here, and the spread is based on the difference between the all equity cost minus the cost of debt before tax multiplied by 1 minus the tax rate times the debt to equity ratio. So in this graph here, we see three lines. One is the cost of debt, which is a constant amount regardless of the debt to equity used. And then we have the blue line here, which is represented by this formula, the cost of equity. And if the debt to equity ratio is 0, then the cost of equity will just be R sub 0. Okay, which is consequently also the WACC of the company if it uses no debt. Now, the weighted average of these two costs will then lead to a declining weighted average cost of capital. Okay, because debt is the interest from debt is tax deductible. Now, of course, there are some useful formulas that you can use to answer questions. Okay, so from the value of the levered company is equals to debt plus equity. So in the exam, you may be asked to solve for the value of equity. So the equity is just the value of the levered firm minus the value of debt. Now, the value of the levered firm can be computed using a perpetual formula. So we can just take the EBIT of the company times 1 minus tax, and then we divide by the tax rate, divide by the weighted average cost of capital. And of course, the weighted average cost of capital is based on the average of these two costs. Now, if you want to calculate the value of the unlevered company, you just take the earnings before tax, okay, times 1 minus the tax rate over the cost of the equity if the company uses 100% equity. Now, consequently, at this point, the R0 is also equals to WACC, okay, but only at this point. Now, if you are looking for the equity value using a similar perpetual formula, then you will take the earnings, the net income, so which is EBIT minus interest, that's EBT, and EBT after tax is net income. So if you take the net income divided by the cost of equity, which is based on the proposition 2, then you will get the value of E, the equity. And the value of debt is based on the interest, okay, divided by the cost of debt before tax. And all these are assuming that the cash flows are perpetual. And interest here, of course, is based on the formula RD, the cost of debt multiplied by debt. Okay, of course, if you cancel out, it works back to D. Now let's look at this example. So Ensoft is an all equity company with earnings before tax of $360,000, and the WACC is 12%, which is also R sub 0 in this case because it's all equity. So the corporate tax rate is 20%. So calculate the all equity value or the unlevered value of Ensoft assuming perpetual cash flows. So in this case, V sub U will be the EBT times 1 minus tax rate over WACC. And EBT here is 360,000 times 1 minus 0.2 for 20% divided by 12%. So the unlevered value of Ensoft will be equals to 2.4 million. Alright, so this is the value of the firm or the value of the equity of Ensoft. Okay, because at this point it doesn't use any debt. Now let's move on. So let's say now with the same details, but Ensoft plans to issue $1 million of debt at a cost of 5% before tax. So calculate the levered value of Ensoft and also its equity value based on proposition 1. So based on proposition 1, the value of the levered firm is equals to the value of the unlevered firm plus the tax rate multiplied by the debt that they're going to issue. So previously we calculated that the value of the unlevered firm is 2.4 million. So let's substitute that in. So that's 2.4 million. All right, plus the tax rate, which is 20%, times the amount of debt here, which is 1 million. So the interest tax shield here will be 200,000 plus 2.4 million. So that's 2.6 million. So this is the value of the levered firm for, in this case, Ansoff. So what's the value of equity? Equity will just be the value of the levered firm, okay, minus debt. So that would be 2.6 million minus 1 million. Okay, so that will be 1.6 million. Right, so this is the value, the equity value of Ansoff. Now let's say for the same case, Ansoff is going to issue $1 million debt, but now we want to calculate the cost of equity, okay, and the WACC of Ansoff based on proposition 2. So if you may recall the formula earlier, the cost of equity is R0 plus R0 minus RD times 1 minus the tax rate times debt over equity. Okay, so we're going to work this number out. So the R0 here initially is 12%, so that's 12% plus 12% minus 5% cost of debt before tax times 1 minus 0.2, so we got that. Debt is 1 million here, so that's 1 million. If you recall, what's the value of equity? Equity is 1.6 million. Okay, so that's 1.6 million here. So this will be equals to 15.5%. Alright, so this is the cost of equity. And if you're calculating WACC, okay, for WACC here, this will be the weightage of debt times the cost of debt after tax plus weightage for equity times cost of equity. So the weightage of debt here will be 1 million. Okay, 1 million. And the total value of the company is 1 million plus 1.6 million, which is 2.6 million. Okay, that's 2.6 times 5% times 1 minus 0.2 plus the equity will be 1.6 million over 2.6 million times the cost of equity, which is 15.5%. So that will be equals to 11.069%, right? So just to make sure that we are on the right track, okay, so if I use the cost of equity here, 15.5%, to, let's say, recalculate, so I'll just use a blue color here. So based on the formula we saw earlier, the equity is your EBIT minus interest after tax, okay, and then we divide by the cost of equity. So what's your interest in this case? We know EBIT is 360,000, but what's interest? So you are issuing a debt of 1 million and the cost is 5%. So 1 million times 5%, that's 50,000. Right, so this is 360,000 minus 50,000 interest. Okay, and this is after tax, so that's 1 minus 0.2, and then I'll divide by 0.155. Right, so if I calculate, this is 310,000 in EBT times 0.8 divide by 0.155, and we come back to 1.6 million. Okay, so that's correct. Okay, we got the number. And just to make sure that the total tallies, so if I calculate VL based on E, which I've computed here, and then of course I still need the D. D will be the interest over the cost of equity, cost of debt. Interest here is 50,000. Okay, and then this RD here is 5%. So of course it will go back to 1 million. Okay, so it tallies up. Now another way how you can check is instead of using this, we can also use the other formula. Okay, let me just rub this off here. So the other formula we can use is for the value of the levered firm, which is your EBIT after tax divided by your WACC. Okay, so EBIT is 360,000, and then this is after tax is 1 times 1 minus 0.2, and then the WACC is 11.0769. Okay, so if we calculate this, just make sure we got the right number. Right, so it comes up to about 2.6 million. Okay, 2605. Okay, 0.417. Of course, there are a bit of a rounding error there because we didn't use all the numbers. Okay, but it should come up to about $2.6 million there.